All right. Greetings, everybody. Hope you're all having a good day. So, pretty stunning win, I guess, by Trump. I'll tell you what, though, like most people, I had no idea who was gonna win or what was gonna happen. But maybe around 1 or 2 in the afternoon yesterday, I saw an analyst talking about how many more people have registered to become Republicans than Democrats over the last 4 years. It's like been this. I don't know the numbers off the top of my head, but it was like this really, really big shift. So when I heard that, I thought that Trump was going to win big, and yeah. So anyway, market likes it, but let's just take a lesson here on the Trump stock. The action today is actually pretty weak. Now you might say, "Well, what the hell are you talking about, Mark? It's up $2.50." Well, I look at instead of where we are versus yesterday's close, I'm looking at where we are versus today's open. All right, and the stock opened. Well, actually, we can just look at the 1 day chart here, and we opened at the highs of the day, and then the sellers have been knocking it lower ever since. So, in that sense, I think the action is kind of weak. Now, remember, we could talk about earnings, we could talk about this, we could talk about that, we could talk about the other thing, anything you want to talk about. I give dating advice. I should probably give something to myself. Better now let my wife hear that. All right, whatever, man. Sorry. Now, what the hell was I going to say? Oh, yeah, it doesn't. If a market runs out of buyers, right, that's when a market forms a top. So if you get real excessive bullishness, it's a contrarian signal. It's bearish because think about it. If everyone who wants to invest invests all the money that they have, there's no one else left to invest, and the market runs out of buyers, and we could go down, right? So you see that a lot. Sometimes a company reports really good earnings, but the stock goes down. Well, that's because people that wanted to buy it took their positions before the earnings came out. So when the earnings came out, good, bad, or indifferent, it's like there's no one left to buy it. So it ain't going to go up. All right. Anyway, going here to, I got to go back to my notes. Don't say anyway. Don't say so. Boy, I'm trying so hard not to say anywhere. So, well, let's look at this 5350 level. Okay. It was resistance back here, and then it became resistance here within pennies, right? You don't need to be a hedge fund guru to see this. So early May, around 53 and a half was resistance. The stock goes lower. What happens? A lot of the people that bought at the resistance are like, oh, this sucks. I'm underwater. I shouldn't have bought the stock. If it gets back to my price, I'm going to get out at break even. So when it finally gets back to their buy price, they place sell orders. And if you have enough of these remorseful buyers placing sell orders, the level that was resistance becomes resistance again. And you can see this is what happened here on October 29th, last Tuesday. Yeah, so look at that high trade 58, or sorry, 54. Well, let's look at the opening trade. Opening trade 53.75. So 25 cents on a $50 stock. I mean, that's pretty well. Now, next thing you might notice is when things get to resistance, they sell off. Well, resistance is this large group of sellers. And sometimes they start to get worried. They know the buyer is going to go whoever is willing to sell at the lowest price, and they don't want to get undercut. So they reduce the price they're willing to sell at. Other sellers see that and do the same thing, and it becomes this like snowball effect that pushes the price lower. One thing I can point out to you here is this pretty classic, what we call the bearish engulfing pattern. You can see one down here. You can see one here. Sometimes trends, this is one over here too, but this one didn't play out. This one told us that the rally was going to be over and we were going to go sideways, but these ones were bearish. This is typically a bearish thing. Just think about this. The blue team is in charge, right? The bulls are pushing the stock higher. And on this particular day here, May 31st, it looked like it was going to be another up day. In the morning, this is where the stock opens. But by the close, what had happened? The sellers had pushed it all the way back down. Now, importantly, we went below the prior day's open. So the trading engulfed all of the price ranges of the prior day's trading. And that's where the name comes from. So bearish engulfing pattern, it's a Japanese candlestick pattern. What's kind of amazing is candlestick charting has been around for 700 years, and people are still looking at the same patterns that they were 700 years ago, and that's because human psychology has not changed. Here's another one, right? It looked like it was going to be another up day. It opened higher than the prior day's close, but the close was lower than the prior day's open. So those are just a couple things on Trump here. You could also say that this is kind of an exhaustion pattern. So remember, even though now it's obvious, well, I mean, I guess he's won the election. If everyone who wanted to buy the stock bought it already, it's just not going to go up. That's just not how it works. And I'll just spend a couple of minutes on the VIX because, like many things on Wall Street, the VIX is widely misunderstood. And I never even look at it. And the reason why is because I don't need to. If you look at the stock market every day, you can see if it's selling off or you can see if it's rallying, right? Now, the VIX is misunderstood because it's called the fear index. What the VIX is, the best way to look at it is it's the cost of insurance. Okay. If you're a portfolio manager and you have a big portfolio, say $100 million portfolio of 20 or 30 different stocks, and you think the market's going to go down, well, you can't, it just doesn't make sense to sell all those stocks. You might not even be able to. You might have an obligation that you can't have maybe more than 5% cash in your account or what have you. So what do? You go out and you hedge yourself. You buy puts. Puts are something that's going to go up if the market goes down. So the idea is that you make as much profit on your puts as you lose on your stocks, and that's what we consider the hedge. Now, the more freaked out you are that the market's going to go down, the more willing you are going to be able, or the more willing you are going to be to pay more for insurance. In other words, if you don't have fire insurance on your house, and I don't know if that's possible, but your neighbor's house burns down, well, guess what? You're probably going to be willing to pay more for fire insurance than if there hadn't been a fire in your neighborhood in 50 years. Now, it's miscalled the fear index because think about it, it could also be called the euphoria index. When the when the market peaked out here, where are we here? Right at the end of 21, we had these big spikes in the VIX. And I remember reading articles where people are like, oh, the rules of the VIX have changed. And no, they haven't. They just show that the people that write the articles don't understand what they're talking about. Um, if if you're afraid of missing out on a huge rally, if you're euphoric, guess what? You're going to be willing to pay more to get into positions. Just like if you're freaking out, you're going to be willing to pay more to get in position. So the VIX can be called the fear index, but it can also be called the euphoria index. Anyway, if you look at the market every day, you kind of really don't even need to watch it because you just kind of know what it's doing. It's just kind of like inverse-ish to the market. All right. Hope that helps everyone. I will see you soon. Thank you.